In today's video, I'm going to give you guys 5 reasons why dividend growth investing is the best way to structure your portfolio to ultimately reach financial freedom. There are a few key things you must follow here in order to do this right, so make sure you watch until the end. With that being said, let's get into the video. What's up guys, welcome back to the channel, and if you are new to the channel, welcome. My name is Johan Lorenzo, and in this channel we talk about making money in the stock market, mainly through dividend growth investing. If that's a topic you're interested in, I'm inviting you to subscribe to the channel and come along for the journey. So here are the main reasons why investing in dividend growth stocks is one of the best ways to help you reach financial freedom. And as with everything else, there's a proper way to do this and a not so proper way to do it. We'll cover all of that towards the end of the video, but for right now, let's jump right into these 5 reasons. Reason number 1, you get the chance to create an extra stream of income. You will have a consistent stream of income each and every single month through the form of dividends. Although most stocks pay a dividend every 3 months or so, you can structure your portfolio in a way where you're getting paid monthly. This will most likely happen on its own as you start investing in your favorite dividend stocks. If you invest in 15 to 30 stocks, chances are you will be getting paid dividends every single month. Some months might be bigger than others, but nonetheless, you will have every single month covered. Reason number 2, you get paid no matter what. Whether the price of the stock goes up or down, you're gonna get paid. And this is why it's very important to invest in solid companies that have been through and survived all types of market crashes. Also, having this type of income is great during a market crash because not only does your income stay the same, it actually packs way more of a punch during a market downturn than if you're buying shares at all-time highs. Reason number 3, you can literally live anywhere and still have this stream of income coming into your account every single month. It doesn't matter where you live. You're gonna collect those dividends no matter what, and for putting out zero effort whatsoever. Whether you live in the beautiful free state of Florida, like I do, or anywhere else in the country, it's not going to cost you anything extra to collect your income, which that is absolutely amazing and is one of the great advantages of dividend growth investing. If you compare that to owning physical real estate and having rental properties, you're pretty much tied down to that general area for the most part, or you're going to have to pay someone to manage your properties for you. Not only does that eat away at your profit, but it's way more legwork on your end. A large stream of income from a dividend portfolio is a true stream of passive income. So now we're at reason number 4. It doesn't require any hard work and it doesn't consume any of your time. Once your portfolio is all set up and you have all of your stocks laid out in front of you, this is pretty much a set it and forget it type of investment. I guess this makes for a good time to use a quote from one of the greatest investors of all time, Warren Buffett. If you don't find a way to make money while you sleep, you will work until you die. Reason number 5, you don't actually have to sell your shares to make a profit. You will be generating an additional source of income that you can use for anything, and you don't have to sell your shares to do so. Let me give you a quick example so you can really get a grip of this. As many of you already know, I am Cuban, and I'm speaking for most Cubans here. We love eating mangoes. If every time I wanted to eat a mango, I walked out to the tree and chopped off a branch in order to get my mango, eventually, I will have no branches left and I'd end up killing my mango tree. This is exactly how I see dividend growth investing when I compare it to non-dividend paying stocks. If you're investing in growth stocks, you have to sell your growth stock in order to pocket your profits. And if you continue to sell your growth stocks to pocket your profits, you will eventually run out of growth stocks. You just killed your mango tree, bro. Now, don't get me wrong. I also buy shares of growth stocks that do not pay a dividend, but the majority of my investments are around dividend paying companies and I wouldn't have it any other way. All right, so what is the proper way to invest in dividend growth stocks? So when investing in dividend growth stocks, there are 3 main things I look for. The first main thing I look for is the payout ratio. What is a payout ratio? This is when a company pays their shareholders a percentage of their net income in the form of a dividend. So people like you and me that are buying their shares will get paid a percentage of their overall net income through the form of a dividend payment. And on a quick side note, this is why investing in the stock market is such an awesome way to build wealth. I don't have to be a genius or the next Steve Jobs. All I have to do is invest in his company and stick my little poor hands out there and collect profits. I don't have to do any of the work whatsoever. I let the smart people do the work and I just sit there and collect profits. When you invest in a company, you technically own a small piece of that company. It might be a small little tiny sliver, but it's a sliver at that. And you can grow your ownership in the company over time as you buy more shares. So for this example, let's just use Apple. I am a shareholder of Apple. Every time Apple sells a computer or a laptop, an iPhone, an iWatch, headphones, whatever it may be, I benefit from that as an investor. And for the sake of understanding a payout ratio, let's say Apple makes $100 million in net income. And out of those $100 million, $30 million get dished out in the form of a dividend to the people who own shares of the company. This would mean Apple has a dividend payout ratio of 30%. And that would be considered a pretty low payout ratio because out of the overall $100 million it generated in net income, only $30 million went to the investors. Meaning Apple can keep 70% of their net income for themselves, and they can use that money to reinvest back into the company and continue to grow and evolve. A low payout ratio of 30% is very attractive to investors because it gives the company some wiggle room. If the company ever has a rough year, they'll still have enough money to pay out their dividend to the shareholders, which means we still get paid no matter what. The second main thing I look for is their track record of consistently paying out dividends. Generally speaking, you want to be invested in stocks that have maintained their dividend throughout all types of market conditions. This goes to show the company is pretty solid and can continue to pay you, the investor, in the events of another market crash. That way, no matter what happens in the market, we're getting paid. And if you don't know where to start looking for these types of stocks, just go and search Dividend Aristocrats or Dividend Kings on Google. You'll see companies that have 25 and 50-year streaks of consistently raising and paying their dividends. And the third main thing I look for in these companies is how many times have they consistently grown their dividend over the years? This is pretty much the cherry on top of the ice cream sundae. Not only are you getting paid consistently throughout the years, but you're also getting a pay raise. Not only does this help fight inflation a bit, but when you have 15 or 20 different companies giving you a dividend raise, your income will increase dramatically without you ever having to add another single share to your portfolio. This is for anyone who is struggling right now to build up their dividend portfolio or build up their monthly income through dividends. As you start building out this portfolio, your monthly payments are probably going to be pretty low. Unless you're starting out with a pretty large amount, like $100,000 or something like that, chances are your first few months of dividend payments are going to be pretty low. But I'm here to tell you this: keep going. In order for you to get to those fat, juicy months of dividend payments, you're going to have to stick through it and you're going to have to continue to reinvest the smaller ones. This will help you get that snowball effect going. The snowball effect is when you decide to reinvest those monthly dividends and you begin to compound the growth of your portfolio throughout the next couple of years. Doing this throughout the first few years of your portfolio will make a huge positive difference in the growth of your overall portfolio. Here is a chart so you can see the difference for yourself. The S&P 500 total returns with dividends reinvested is in the blue, and in the yellow, you'll find the growth without the dividends reinvested. It makes a world of a difference. Before I let you go, I want you to think about your magic number when it comes to the monthly income you want to receive from dividends, right? What is your magic number? Is it $2,000 a month? Is it $5,000 a month? Is it $10,000 a month? Aim for that number and do not let off the gas until you get there. And I know you're probably thinking to yourself, man, this ain't gonna be easy. This is gonna be hard. And I'm here to tell you, you're damn right it's gonna be hard. It's gonna be very hard. But guess what? It's gonna be even harder when you're 65 years old and you're dead broke. That's gonna be even harder. So choose wisely. Don't forget to smash the thumbs up for me, guys. Don't forget to subscribe to the channel if you haven't. I wanna thank you all for watching. I'll catch you on the next one. Peace!